So last week, a lot has happened. And in this video, we're going to go over Trump's tariff on Canada, inflation, and some advanced investing strategy using your IRA account in the United States. And we'll talk about cryptocurrency and also finally how you can allocate your portfolio with these advanced alternative investment strategies. So my name is Eric. I'm a CPA. I'm a chartered investment manager. So let's get started. Last week, the US released its latest inflation data for December, and it was very surprising. So I'm going to walk you through my forecast, what we do in Investing Accelerator, the weekly coaching call, and also my inflation forecast for the next 6 months. Here you can see the inflation slide, and basically within Investing Accelerator, we have a weekly coaching call where we look at major macroeconomic data like inflation on a weekly basis. I also have a forecast, and it's fairly accurate in terms of what to expect. So the latest inflation data is 2.2%. The forecast was more conservative at 3%. I actually was expecting around a 2.7% inflation last week. So for the last couple of months, inflation ranges between 2.8, 2.5, 2.4, 2.5, 2.7. This is okay, and we're within targets because the Federal Reserve wants the inflation to be between 2% to 3%. Looking at the index, we can see 314.5, 314.7, 315.3, 315.6, and 315.4. From September, October, November, these 3 months are actually flat, and the inflation index is steady. So without even looking at what the number is last year, you just need to understand that the inflation index is steady. My projection was that there's a slight increase because that's kind of how natural inflation works. It would go to 316 and get you to 3%. But instead, the December inflation was actually 313.68, representing a drop from November. That's some kind of deflation on a month-to-month basis. On a year-to-year basis, it's still increasing, but month-to-month, it's declining faster than expected. If you look at last year from 307 to 36.7, you would only expect this number to be around 315, maybe 314, but this is actually dropping to 313.6. And that means prices are going down. And it's good and bad. So the first thing is that when inflation is dropping faster than expected, it means the Federal Reserve's economic policy is working. So that's great. Now, on the other hand, when it comes to fast dropping inflation or deflation, it also means that corporate prices, like the price of eggs, are coming down. Then you're going to see in certain categories the profits for these corporations are going down. Inflation also includes housing prices, so housing prices might also be going down. There are two impacts. You might go to the supermarket and you see that the price of eggs is coming down, which is great, but then you also see that the value of your home is also going down, which is not so great. So generally, if you want the country to be wealthier, you want to be holding on to assets that go up in value. For example, your home goes up in value every year, but then that also means your eggs, meat, or whatever your groceries are also going up in value every year. So then the question is just which one is going up in value faster? Now, the good news is that with inflation coming down faster than expected, this gives the Federal Reserve a lot of wiggle room to lower interest rates. So back in December 16th or so, the Fed came out and say that the inflation is quite high. They're not going to be cutting rates as much as expected for 2025. So they're only forecasting around 2 rate cuts. Now, with the current inflation data, 2.2%, going down faster than expected in January, this actually gives the Fed the narrative or the opportunity to change their narrative to increase the number of rate cuts. If you look at Canada, you will see that Canada is already cutting rates, very consistently, like 0.25% every quarter or so. They are already at 3.25%. for Bank of Canada interest rate, whereas for US, it's still elevated. That caused a big change in the US and Canadian dollar exchange rate. With the current inflation data you're going to see more rate cuts in 2025, which means the stock market is going to be bullish in 2025. So your goal as an investor for 2025 specifically is that you want to invest as much as possible near the beginning of the year. So you want to be fully invested. For my own portfolio, I'm fully invested as of January 1st. Whenever I get more capital, I invest in the market. So then it rides on the bull wave. And my forecast for the bull wave for 2025 is between March to July. So that's what you're aiming for. You want to be invested before March. For January, February, I still expect it to be choppy. Now let's go back to the inflation forecast. Here you can see that I have created the projection for the next 6 months. I'm still using the elevated inflation data. So 2.4% next month, 1.5%, 11%, 1.1%. This is already below the Fed's target, meaning the economy's prices are not going up fast enough. Usually the target is somewhere around 2 to 3%. And this gives the Fed the opportunity to lower interest rates, which then smooths out the curve. So instead of reaching 0.9%, most likely what you'll get is after March or April, they'll be cutting rates a little bit more aggressively, and then that will increase the inflation slightly. So then you don't get to an inflation level that is below 0%. So that's how I would think about this inflation forecast. So it wouldn't go all the way down, but instead it just levels off somewhere between this 1 to 2%. When it comes to investing, that's great news because as interest rates decrease, more capital will flow into the market. There's a couple of considerations, like where would the capital flow to? The obvious choice is, of course, the index, so you would just invest in S&P 500 index, but some people speculate it will flow to the international market. For example, if Trump and China have a better relationship, like the Hong Kong stock market. The second one might be small cap tech stock. As the interest rate is coming down, it is easier for tech companies to get loans to fund operations. So they will go up in value. Small tech stocks, startup, venture capital companies will be attractive. Now, what will be unattractive? For example, if you're looking at like mortgage-backed securities as the interest rate is coming down, new mortgages are actually at a lower interest rate. So then you wouldn't be buying mortgage-backed securities because you can't get as high of an interest rate anymore. For example, those secondary mortgages, hard money loans that require real estate as a collateral, those T-bills, money markets, those returns will be coming down because you don't get the high Federal Reserve interest rate anymore. And it'll shift toward equity, whether that is small cap, big cap, or international equity. Money will be flowing out of the US dollar once the interest rate comes down enough. But in the meantime, let's say we're talking about US and Canada, whereas the US interest rate is still elevated, but the Canada interest rate is only at 3%, money is flowing towards US at this moment. But then that will change once the interest rate comes down a lot faster. So that's how I would think about inflation, the latest data, and what it would be for the next 6 months. Taking the office, and the first day, he's enacting 25% tariffs on Mexico and Canada by February 1st. That's actually pretty crazy how quickly he acts, much faster than I thought. So there are a couple of potential implications here. The first one is obviously the Canadian goods become more expensive to the US consumer. So let's say, US imports gas from Canada at $1. So with the 25% tariff, it's going to be $1.25 when it gets to US. Canadians, you're still going to get the same $1 gas as before. However, reality is not that simple. The refineries are actually in US, so it would go past US, get hit by the tariff, and then come back to Canada. So I don't expect the Canadian gas at the consumer level will get that much cheaper. So they're going to get 25% more expensive gas. This will actually encourage US to drill more oil, which I suppose that's where Trump got his donations from. Canada is also an exporter of minerals. So anything that has metal in it will hit 25% tariff. That will possibly encourage more mining in SS. But to be honest, the natural resources are in Canada, so that means the price of goods for US consumers will be higher. Now, the next one is that Canada manufactures a lot of automobile parts. For this one is a little bit tricky because you get the parts from Canada and there's a 25% tax on it. That will make your pickup truck, your SUVs, more expensive as well. It might not be exactly 25%, it might be 5 to 10% more expensive. Over time, it is possible for the automotive manufacturers to move manufacturing back to the US. But that wouldn't happen immediately. And you're basically relocating the people in Canada back to the US. Now, one interesting thing is that the US salary is higher than Canada. For example, a senior accountant that gets paid around $80,000, $90,000 in Canada gets paid around $120,000 in US, and that is in USD and one is in Canadian. So in reality, the senior accountant, speaking as a CPA, getting paid $80,000 in Canadian is really just $60,000 in US. And with such a weak Canadian dollar, it's like $50,000 US. So now you're incurring a higher labor cost in the US, forcing companies to move manufacturing back, even though Canada and the US have been trade partners for many years. Through being the largest trade partner, Canada will go into an economic downturn. Now, the interesting thing is that Justin Trudeau, our Prime Minister, actually resigned a couple weeks ago. So that means the Canadians can no longer blame that on him. It's going to be the next Prime Minister to resolve that issue. So with him being out of the way, Canada being real estate reliant, lowering interest rates faster than US, even though based on my forecast, US is going to start lowering interest rate as well. And then the Canadian dollar will become even weaker. The Canadian dollar will probably need to adjust upwards, let's say by 10 or 15%, in order to stay competitive against the alternatives. So here's an example. Let's say the Canadian automotive part is $10 a piece. Gets hit by a 25% tariff. So then you're looking at something like $12.50. If the Canadian dollar goes down by 10%, then it becomes $11. The cost is then shared somewhat between the Canadian dollar weakening against the US. Either way, US consumers, you're paying more for sure. It's just a matter of how much the Canadian dollar is going to weaken to compensate for that. So you know the gain or the increased prices is not going to be exactly 25%, but it's going to be higher eventually. The good news will be that this brings inflation back. We want inflation to go away, which right now is 2%, and the economy is extremely strong. Put the tariff on raw materials, which Canadian companies, mining companies mainly produce. So then all of the prices that US consumers that has a Canadian or Mexico component will have an increase. Then there is going to be inflation coming back. The Federal Reserve is correct in the sense where, given that Trump is going to enact the tariff on Mexico and Canada, inflation is coming back, so there's really no need to lower the interest rate, which then further hits the Canadian dollar and makes it even weaker. So that is very interesting. Let's read the rest of the article. Here we can see that February 1st, 1.8 trillion goods and services. Now that's really hard to imagine, but basically cars, gas, wood, and anything that is like mining, like diamond, metal, you name it, like very raw materials. GM imports 30%, Ford imports 25%, boosts new car prices average by around $3,000. If your car is around $30,000, $40,000, it's going to be an increase of 10% or so. Like I said, it's not going to be exactly 25%, and then the Canadian dollar will weaken a little bit more, so you might get a 5 to 10% increase. Previously, Trump put a lot of tariffs on Chinese goods, and that basically killed the Chinese side of business. Trump is killing the businesses of allies as well. So for the last 4 or 5 years, I converted all of my Canadian dollars into US dollars. As the US dollar continued to appreciate in a post-COVID world, it also helped with the investments mainly in tech. So that's really how I view the US dollar at the moment against the Canadian dollar. Other than some of my expenses in Canadian dollars, a surprising amount of my assets are in US dollars or even some in Bitcoin. That's how I hedge against this risk, which unfortunately becomes true. We'll go through some advanced investing strategies that you can deploy in your IRA, which I don't usually talk about. This includes real estate, cryptocurrencies, private placement, checkbook, and promissory notes. I'll also give you a couple of options in terms of brokers you can use. And if you have been following me for a while, you know that I mainly focus on buying public equities like stocks, options that you can easily do in your IRA account for Charles Schwab, Fidelity, or the broker I use is Interactive Broker mostly. So I'm not affiliated with any of the brokers, so I'm just going through the website with you, each of the options, explaining what it means. This will give you more ideas on what you can do with your IRA account and potentially getting a higher return as well. So let's get started. So first, let's talk about the two different brokerages I found. The first one is called IRAR, which stands for IRA Resources Trust Company. The second one is Alto, which is also an IRA platform for alternative investments. So in IRAR, here you can see that there are a lot of different investing options. And the first one is real estate. This can be in terms of directly invested in real estate equity, like development projects or mortgage notes. And this is usually location specific, like you're investing in a specific property in a specific region. The other one, which is less popular, is private placement. That means you're actually buying private stocks of a company. So if you are working for a startup, you probably get equity from the startup, but you can also participate in the private placement as an investor to buy more shares. This can be in the form of common shares, which you might not get a dividend for, and you're holding it for the moonshot, like you're trying to invest in the next Google. This can be in the form of crowdfunding, like Reg CF, where you invest a small amount of money, and you can do so even if you're not an accredited investor. And there are also certain types of shares like preferred equity, more consistent monthly dividend. So for example, right now, my company is raising capital, preferred shares, with a target dividend of 20.5%. So that gets offered through a private placement. And what the company needs to do is register with SEC, Reg D, and they can choose between 506C or 506B on whether or not you can accept accredited investors or a limited number of non-accredited investors. I think it's up to 35. And here you can also invest in hedge funds as well. So if I set up a private fund in the future, it will also be considered a private placement. So you would use your self-directed IRA to invest in these. The benefit of using an IRA instead of a traditional cash account is that your tax reporting becomes a lot easier, and the dividend you get, let's say the 20%, is tax-free, or at least tax delayed for a traditional IRA until you take it out. If you're trying to do some tax planning and you're getting some rental income sources that you know will be taxed, and a 20% dividend from private placement, if it is in your IRA account, you can choose not to take it out and use those funds to reinvest in something else. That allows you to have more flexibility in terms of when you want to take the money out. And that's really what I recommend for a lot of people when it comes to investing in these high yield preferred shares, is that you use a Roth IRA, because the 20% you get for dividend will be taxed as income if it is a foreign company. But if you're using a Roth IRA, the dividend has zero tax. That is actually very beneficial. And then for the more long-term investments, you can do it under your own personal name. So the next one is checkbook control and then promissory notes. So this can be collateral-based promissory notes, like some people do on real estate, similar to a mortgage. Sometimes it's backed by other collaterals, like the equipment of a company. or sometimes it's unsecured. Usually the unsecured ones have higher risk, but also a higher interest. There are some additional IRA assets that you can hold, like energy, oil and gas, AR. That is like accounts receivable for medical debt. I know some people that invest in those. Joint ventures, similar to private company shares, and life settlements. Those are the kinds of investments you can hold. For IRA resources, you don't see cryptocurrency on there. Now we'll jump over to Alto IRA, and there is that additional investment option. So now we're at Alto IRA, and between the two companies, the fees are very similar. There are some account opening fees and transaction fees. Below here, you get the typical marketplace where they're featuring some capital raises. And then here you can also see that there's Alto Crypto IRA. So there's, let's say, 200 different coins you can invest in. That's your first option. The other alternative is actually to buy the index funds for the cryptocurrency as well. So for the index funds, it's more of a recent phenomena. So for example, for Bitcoin is IBIT. That's the iShare Bitcoin Trust. So this is the one I would recommend. Don't worry about the indicators I have on here. It just helps me identify the bullish and bearish period. So investing in this will get you very similar gains as if you invest directly into Bitcoin. So if you really want to use your IRA account to invest in cryptocurrency, you can either do one of those trusts or you can use these alternative investment platforms. When it comes to cryptocurrency, my view is to hold on to the coin itself, meaning that I don't go through the fund. And the reason is because the whole point of cryptocurrency is that it's decentralized. If you want to move it anywhere in the world, and you can do this with a crypto wallet. There are centralized exchanges like a broker. For example, the Fidelity version of cryptocurrency would be Coinbase or Kraken or Crypto.com. If you hold it there, I think it's okay because you can recover your password, but then you don't truly own the coin. So you truly own the coin when you hold the coin directly on your wallet, and then that's what I do. And that actually reduces the supply of, let's say, I hold Bit and there's only 21 million Bitcoins in the world. And if I hold one of them, that reduces the supply by one. And over time, the supply will get smaller and smaller and smaller, while the demand gets higher and higher and higher, which then drives the price up. Whereas if you're investing in the fund, that might not directly contribute to the fund holding more Bitcoin because other traders can short it, can use options to hold it as collateral, and it can get very complicated. So if you're considering cryptocurrency, my first go-to option is always to hold the coin directly, because then it means you are free from any political environment and you're not obligated to be storing it with any specific centralized exchange. Now we have gone through two of the brokers for alternative investments for IRA accounts. So you can use your IRA account to invest in real estate, private placements, promissory notes, energy, oil and gas, and also cryptocurrency as well. So that's actually quite a few investment options that you can choose from, and it might seem overwhelming. When it comes to managing your own portfolio, you want to take a step back and determine how much you want to invest passively. So the answer to that might be around 70 to 80%. Then you can do like 10 to 20% high risk in public equity or alternative investments. If you're investing $1 million, 700K should be in index funds like S&P 500. So that you don't need to worry about it. You buy it, you forget it. And then you have 10 to 20% for things you think will go up significantly, like Bitcoin. That also seems like a no-brainer at the current time I'm recording this video, but it might change in the future depending on the price. So you might do like 5-10% on Bitcoin, maybe more. And then afterwards, let's say you want to invest in a startup. Let's say you think SpaceX is one that you want to invest. Then you do another 5-10% there. Or you know of another startup like the one I'm doing, and you want to get 20% dividend, you can also invest there as well. So then overall, your portfolio is diversified, right? A large portion is in kind of medium safe investments. getting you ideally more than 10%. If you're getting less than 10%, then S&P 500 gets you around 10%. And then you have some of these moonshot opportunities that either gives you very high cash flow, like a 20% dividend, or very high growth, like 20 to 30% growth in terms of the company per year. So those are really the key considerations when it comes to constructing a portfolio. Now, it is possible to make the portfolio even safer by incorporating some bond, cash deposits, guarantee certificates, or T-bills. But that is really just parking your cash in a very safe instrument until you see an opportunity. So if you're just holding cash versus holding a T-bill for a couple of months, it doesn't really make a large difference. The question is, where are you really deploying the capital so you can achieve a higher gain? That can be the S&P 500 as the foundation, or whenever you see an opportunity you're interested in. The key here is that when you see these high risk opportunities, you only allocate an amount that you feel comfortable with to achieve the return. If you over allocate, it'll be risky, but if you allocate just the right amount, you're not taking unnecessary risk. Let me know if you have ever invested in these private placements before, or cryptocurrency, or even if you are investing in private real estate. I would love to know in the comments, and I'll see you in the next video.